Good morning, everyone, and thanks for joining today's M&A panel presented by ACG Pittsburgh's Future Corporate Leader Board. I'm Aaron Kolko, a senior manager in BDO's Transaction Advisory Services Group, specializing in buy-side and sell-side financial due diligence for a wide array of clientele, ranging from small private investors and private equity firms to large publicly traded corporations. I'm also an ACG Pittsburgh FCL board member and will serve as today's moderator of the discussion. Before we get started, I'd first like to thank all of our ACG Pittsburgh sponsors. We wouldn't be able to have events such as today's without your generosity and support. In order to thank our sponsor for all of their efforts and sponsorship during the pandemic, we'd like to offer two additional benefits. The first is free access to virtual programs and other events for anyone at your company or firm. There also is the added benefit of one free membership for someone under the age of 40. If you're interested in becoming an annual sponsor, please reach out to Micah Whitfield or any other ACG Pittsburgh staff member. For our attendees today, if you have questions during the event, please use the Zoom Q&A function. The panelists will do their best to then answer your questions toward the end of the program. I'm joined today by three seasoned M&A professionals, Christine Carpenter, Mike Venditti, and Curry Cornelius. Christine, could you please kick off our panelists' introductions?
Sure. Good afternoon, everybody. My name is Christine Carpenter, and I have been an M&A attorney for the last 10 years. Most recently, I'm at Wabtec serving in the M&A senior advisory function, and we're a highly acquisitive strategic buyer. In the last 5 years, we've done over 60 transactions, essentially tripling our business from $2 billion when I joined to roughly $9 billion in revenue this year. Prior to serving as M&A counsel at Wabtec, I was at a regional law firm helping with buy and sell side transactions.
Curry, would you like to go next with your introduction?
Yeah, sure thing. I'm Curry Cornelius. I'm a director with Slate Partners. We're a Denver-based boutique investment bank focused on building products and building services. I've been an M&A advisor for 10 years, been in corporate finance for 13 years, and the great majority of my M&A work has been in the construction and building industries. I am based out of Denver, where it is snowy today, but it's a pleasure to be with you all.
Thanks, Curry. And Mike, would you like to conclude our panelist intros?
Absolutely. Thanks, everyone. Mike Venditti. I'm a vice president at PNC. I've been here at PNC Mezzanine, that is. I've been here for the last 10 years, where I'm responsible for the entirety of a private equity process, including sourcing, negotiating, structuring deals, and then working with the companies through my participation on the board of directors with an ultimate goal of exit and sale. For those not familiar with PNC, we are a lower middle market investor of PNC Bank. Our group has invested over $1.5 billion since its founding in the late 80s, including 100 platforms that have done almost 500 acquisitions. We currently have 30 companies in our portfolio, ranging across various industries, but largely manufacturing, distribution, and service businesses. We invest about $100 million a year in control and non-control debt and equity securities. And previous to PNC Mezz, I was at a wine fund in New York, and also spent some time as an investment banker, focusing on restructurings, workouts, and turnaround situations. And happy to be here today. Thank you.
Thanks, everyone. Before we get into our panelist discussions, I'd like to highlight a few recent year M&A trends to set the stage. Between 2014 and 2019, global private equity dry powder doubled from 400 billion to over 800 billion. There also have been record cash balances on corporate balance sheets over the last 3 years. In terms of deal volumes, middle market global deals averaged about 2,000 per quarter for 2017, 18, and 19. We saw a steep decline to 1,600 and 1,400 deals and the first quarter and second quarter 2020, respectively. And we've seen M&A rebound to almost the 2,000 per quarter deal count as of Q4 2020, in line with previous years. For our first panelist question, we'd like to discuss current M&A volumes and activity. Mike, could you please lead off with your insights?
Sure. Well, kind of furthering some of those statistics, Aaron, volumes were down off last year for obvious reasons, but seeing them really roaring back this year, I think that's a combination of several things. You've got a lot of the deals last year that, were slated for exit that were pushed. So those are all kind of stacked up in the queue. And then you have the normal kind of 21 activity, all kind of representing, I'd say, larger than normal activity currently. But digging into that a little bit more, because what we're seeing is a lot of that activity is still on the smaller deal side. So call it sub 5 of EBITDA. But largely, family independent sellers, we'll say owner operators, the sellers who are also the COOs of the businesses. So the individuals running the companies versus institutional. So on the institutional side, I think a lot of the private equity firms, there's still some uncertainty. Some of those strategic initiatives of last year were tabled. So I think those exit horizons have been pushed out a bit. But for the owners, again, smaller businesses that lived through COVID, they don't want to do it again. They're tired. Maybe going into 20, they were on the fence of selling. They didn't have the opportunity to do that last year. So I think, coming on the other side of COVID environment, they're really on the other end of their exit timeframe, and they're kind of pushed to the edge. We've seen that sort of in our deal activity. We've been chasing certain deals for multiple years. And over the last 6 months, 2 in particular have come to fruition. Again, it's the classic, retired age owner, not ready to exit. We've been calling them. He finally called us a couple months ago and said, look, I lived through 20, don't want to do it again. I'm ready to go. But in terms of the sort of larger businesses, the private equity backed companies, there's still a lot of uncertainty. So I think a lot of that activity potentially will be pushed later this year. So I think what all that kind of sums up to is still increased valuations for the best assets, given there's not a lot of them, and really a barbell curve. You think there's a lot of smaller, I don't want to say junky businesses, but businesses that were really nicked up last year that still needed to exit. The banker books have a lot of COVID add backs. Again, a lot of that, and a very few good deals on the other side of the spectrum, and really not much in between. So I think, from our perspective, buyers and sellers, to get to a deal, you need an active seller and a willing buyer, but aggressive buyers are winning on certainty of closing. The sellers are asking for COVID add backs, and for the most part, we're seeing them being accepted, especially as we roll into more months of 21 where, March of 20 is in the rear view mirror and rolls off of trailing numbers. So I think there'll be a lot more certainty in the next couple of months. And coupling all of that with the debt markets being very stable, again, is pushing up valuations for the best assets in the market.
Yeah, and this is Curry. I'm actually surprised at those statistics when I first heard them, and I'm surprised in 2 ways. First, I'm surprised that Q2 is actually that robust, because from our perspective, and we only do about 6, closed transactions a year. We're relatively small but focused shop. And to think that 1,400 deals or whatever the statistic was, were done in Q2 is kind of hard to imagine, because from our perspective, and I think from the perspective of most of the lower middle market, it was kind of a ghost town in the M&A market. There was just no one out there because the pandemic was so widespread, and its effects, basically hit everyone, that it was just really hard to take a deal to market, because to close a transaction, you really do need some level of certainty around projections. You need that for lending. It's very difficult to get a deal done in such a volatile market. To take you through it chronologically, after Labor Day of last year, activity certainly came back, and it came back in a big way. And that is carried through to the new year. And I would echo what Mike said. This kind of time we're going through right now is interesting because, leading up to 2018 and 2019, particularly in the industries that we focus in, which is again building products and building services, which is any service that goes into the built environment. There was even uncertainty then because of how long we had been in an economic expansion. And there was a lot of hesitation around the residential building market, fears of 2008 kind of returning, even though the statistics did not indicate that they would return and that we had never really returned to, the level of supply we needed in the building market to satiate the demand that we were having, through those periods. And fast forward to today, and the residential market has gone absolutely crazy, and the demand is through the roof. And it kind of ties into the M&A markets overall, because as we go into 2021, the recession and that feeling of we're really deep into an economic expansion is gone. It's mostly lifted, and we're also coming out of the fog of COVID overall, and what that results in is an immense level of activity in M&A transactions. Like Mike said, there's some leftover transactions from 2020 where they're private owners that just say, gosh, I can't do that again, and I'm just worn out, and I was thinking about retiring, but times were good, but now I'm definitely retiring, and I'm definitely going to transact. But also from the supply side, there's an immense amount of cash out there, and I'm sure Christine can echo this, but strategic balance sheets. A lot of companies, despite the headwinds in 2020, did very well throughout the year. And also private equity firms continue to raise immense amount of capital. So with that much liquidity sloshing around in the markets, plus some motivated sellers, valuations will definitely stay high, but we're looking at a very active 2021, 2022 as we, kind of restart the clock on the economic expansion.
Yeah, that's very consistent with a lot of the trends we saw. We look at COVID, at least in the last 12 months, as almost 4 phases. That first phase of sheer panic and uncertainty, where almost every deal was paused or indefinitely delayed. And then in the summer, companies were primarily concerned with their own liquidity, and really only well-capitalized buyers were purchasing essential businesses with limited risk. And in the fall, we certainly saw a pickup in M&A activity, but it was primarily, as Mike mentioned, the smaller deals, more of a shift to add-on acquisitions and tuck-ins rather than the larger platform deals that we've really seen reemerge over the last 3 to 4 months. And I really appreciated your point about the lending environment. I've spoken to a lot of senior lenders that have large mandates to significantly grow loan volumes in 2021. So we're certainly envisioning a robust M&A activity for the remainder of the year, if not into 2022 as well. For our next question, Christine, how has COVID-19 changed deal sourcing, deal diligence, and deal negotiations?
I think for us, one of the things that really changed was that we typically source a lot of our deals through, like similar industries, through trade shows and through trade events. And as of last year, all of those were canceled, and so we really had to move a number of our deal sourcing to all virtual. And I think one of the reasons why we have started 2021 out of the gate really well, we just signed a $400 million acquisition of Nordco, is because we had built a long pipeline of relationships with our advisors, our law firms, our private equity groups. And essentially towards the fall of last year, we started getting the calls of saying, hey, we know you guys have liquidity. To Curry's point, we know you guys are able to close deals within 45 to 60 days because you always have a deal team ready to complete diligence. And, so for us, I think having sort of a wide array of an external network, truly helped to bring deals to us that we normally would sort of get through our just annual sales meetings or through trade shows. From a deal diligence perspective, we really had to get comfortable with doing diligence virtually. I mean, we're a large manufacturing company, so for us, environmental diligence is really important. Walking through sites, looking at inventory, those types of things typically take significant amounts of travel on our part. That was completely shut down last year and is just now opening up this year in terms of allowing people on site. And so for us, it was really trying to get, leverage our regional support, those people who could sort of make a day trip, those types of things in order for us to get comfortable. We did a lot of Zoom inventory, Zoom presentations. All management presentations are now virtual. So I do think that there is some comfort, I think, in, feeling like we can still have the same types of relationships, over Zoom and, over, technology. But we are really amping up to hoping that there's a nice balance between, still being able to do in-person diligence. From a deal negotiation standpoint, sort of to Curry's point, we're an attractive buyer because we didn't have to have any external lending. And so that really helped us be competitive and to say, we're able to deploy a team within 45 days to complete almost all diligence. And from that perspective, that makes us exceedingly attractive to sellers because we have deal certainty. But the other things that we're sort of now trying to figure out is how do we, in a post-COVID market, deal with any post-COVID liability? It's employee health. What's the health and safety features did you have in place in manufacturing? Because a significant portion of our workers can't work from home. What sort of steps did they take? And what are now it's what's the vaccine plan? And so these are the types of things that we sort of have to grapple with at the front end because we have to integrate these companies into our portfolio, into our employee base, into our benefits plans. So I think those are just a lot of questions that, to a lot of people still don't have a lot of answers, but sort of trying to, mitigate that risk at the upfront of saying, well, has really just, I think, changed the conversation. But I think for the most part, we have just stuck with our diligence principles and saying that, we're still going to run the process exactly the same way as we did it before to get everyone comfortable.
Yeah, certainly, echo a lot of what Christine said. I mean, there's still kind of continued uncertainty. Some of that has kind of a negative bent to it. Some of it has a positive bent to it. And I think when you talk about deal sourcing, deal diligence, deal negotiation, from my perspective as an advisor, deal sourcing has gone completely virtual. Obviously, there's no longer anyone stopping through our office to have in-person discussions, fewer client meetings. And that has, for us as far as our own sourcing, and I think for everyone else too, has kind of moved us to utilize the tools that have kind of been in front of us this entire time, but we just haven't utilized to great effect because of societal barriers and cultural, things. And it's made things actually, I think there's kind of puts and takes for these changes that we're all kind of navigating. Things from a deal sourcing perspective are much more efficient. But they're much less personal, which makes things much more challenging when you're, developing a client relationship where you're going to guide, this company and this owner through what is almost always a bit of an emotional roller coaster when you consider the transaction process. But deal sourcing gone, completely virtual. And I think some of that will carry over to the future, some more Zoom meetings, things like that. But largely we will, go back to more in-person meetings, lunches, coffees. And I think everyone, myself included, is pretty excited about that. As far as diligence and the effect of the pandemic on diligence, we have a client in Canada right now. It's a door and window manufacturer in Canada. And, site tours had to be done completely virtually. And that certainly was a brand new hurdle that we all kind of had to overcome, but have overcome. Virtual management meetings also had an effect on our deal processes because we were able to, instead of inviting, 5, 6, 7 groups in to meet the management team at kind of the roadshow stage of the transaction process, we were actually able to include more buyers in that process because we, pre-recorded a meeting with management where we played the buyer or private equity firm, strategic, what have you, and we're able to include more buyers in the process at that stage. So maybe they could kind of enhance their value, enhance their preliminary indication to take them further in that process. So, will that carry forward into the future? I think it may. I think we will utilize some of those tools in the future, though I think some of the diligence will go back to a little more in person, which, again, thinking on the plus side, my optimistic personality, sometimes, especially the management teams of companies that are not owners, kind of dehumanizing the diligence process and removing those in-person meetings was a challenge because CFOs are under enough stress and throwing diligence lists at them and an arduous diligence process in front of them, plus their day job, plus there's no humans, necessarily that they get to meet and shake hands with during that diligence process. That's a challenging, an additional challenge in a challenging moment anyway. So I think some of those efficiencies will stay, but some of those in-person, meetings will come back where applicable. And negotiations, frankly, have not changed a lot. It was relatively rare that kind of in-person negotiations would occur pre-pandemic for us. We prefer to have kind of a polished message, discuss the ins and outs of any positioning points or negotiating points that we're working with. And frankly, buyers and sellers, they liked the in-person meetings to be more positive, where, we would get on the phone after the fact and discuss with the buyer, the more negotiating points and the things that created friction in a transaction process, of which there are many. So negotiations largely stay the same, but some potentially lasting changes in sourcing and diligence.
Yeah, I agree with everything that was said. I'd add a couple unique comments. We are focusing definitely on our best relationships, given that we're not able to canvas the market, have a shotgun approach and kind of filter through that deal activity to the best ones. Taking much more of a rifle approach, relying on our friends in Denver at Slate, the people that we've already have developed those relationships with, who know us as buyers or investors. They're going to show us the deals that are most applicable for us. I think that's where we're trying to pick our spots. Because in addition to sort of the time, there's a lot of capital chasing these deals, so we need to consider that the time is our biggest constraint, and with the hurdles that are imposed now, it's even more important to be efficient. So, I think of PNC and our strategy for the last 30 years, we're definitely squarely in the value investor sort of space, and I'd say more than ever in the last couple months, we've had discussions about overpaying for businesses relative to what we would traditionally pay for them, for opportunities that we feel best about. So I think it's a long way of saying it's a very competitive market. We're trying to pick our spots, and sourcing is critical to that, keeping that engine going. I'd say the other area that's really is difficult on the sourcing side are for the deals or the opportunities that we historically have chased that were non-process oriented. So, we would meet a local entrepreneur or a family-run business or a group of individuals who owned a company, and maybe they weren't thinking about selling or bringing in institutional capital. There's a lot of hesitations around that. They don't have an advisor, but we'd formulate a relationship with them over months or years and get them over the hump of, how we're not going to come in and disrupt the culture, and we're not going to come in and kick all the family out. But that takes lots of lunches, lots of coffees, lots of golf, just developing that in-person relationship to have a proprietary deal. It's non-processed. It's not being auctioned by a banker. That deal flow is completely gone. You can't just knock on someone's door anymore or shoot a cold email or a warm introduction and expect folks to meet for breakfast and kind of start that dialogue. So that's sort of one leg of our historic sort of sourcing stool. It's completely gone. And then kind of moving through for diligence, echoing the same things that have already been said. We're really trying to be creative. We actually have sort of mapped out geographically throughout the country where we have operating professionals or resources, and have used them in certain instances to help us do the diligence on site, or maybe the seller's willing to meet but we can't travel. Having some advocates around the country where we can leverage that during diligence has been really critical for us. Video tours, again, really anything that we can put our eyes, or again utilize our operating professional network's eyes earlier than later, but again, all virtually. All the processes are virtual, as Curry mentioned. There's no more in-person management meetings. Hopefully that'll go back. And then I'd say on the negotiating side, one of the biggest changes has been, again, given this theme of certainty to close, given an uncertain market, I'd say from practical standpoint, what has meant for us is the LOIs and even early indications of interest have been much more buttoned up, much more extensive. At times, the LOIs that we're agreeing to and negotiating look more like purchase agreements. Again, sellers or advisors don't want to go down the road multiple times with multiple investors. So they really want to get some of these key and critical terms ironed out sooner rather than later. So we're seeing that those parts of the negotiations be accelerated, whether it's talking about reps and warranties, escrows, minority rights if this selling shareholders are retaining ownership. This is definitely an acceleration of those key terms and processes.
Yeah, and that certainly links well with your and Curry's previous comments about multiples being at record highs. And really, if you have a hot asset, a highly desirable business, you're able to mandate that accelerated timeline. A lot of great commentary and points throughout that question. Certainly from my practice's perspective, we've been 100% remote conducting diligence since March of 20. And there's a lot of efficiencies gained and a lot of advantages. First being traveling from Pittsburgh to the West Coast or other remote areas is not easy. And we're losing a lot of times 1 to 2 business days just traveling for target management meetings. Additionally, it puts a lot more pressure when we're having on-site meetings. Now we're stretching what used to be a 2-day in-person process into 6 or 7 smaller conference calls, and it allows us to have more bites at the apple to get us the right information that we need. At the same time, for a lot of target management, it's a lot easier for them just to have 2 business days to block their calendars and not have to worry about 6 or 7 conference calls that disrupts their daily activities throughout an entire month. And then additionally, we don't build the level of rapport, just like Curry and Mike, you mentioned on having, whether it's the proprietary deal or other deal sourcing. It's so much harder to build the rapport with target management that a lot of times helps them get through deal fatigue and ensuring that we're getting the right information that we need. For our next question, Christine, what makes an attractive investment from the perspective of a strategic buyer, and how has COVID-19 changed your M&A strategy?
I think for us, COVID-19 sort of just highlights everything we were always looking for in a business. It just all becomes, much more important. For us, we sort of are a value-based buyer in that we like to keep a strong management team in place. We, are always looking for businesses that have adjacent technologies or a common core customer base. We're really looking for scalability. Are they in a location that we haven't previously been, or vice versa? Is it a product that we can bring to a market that we're already currently in, but the buyer just didn't want to go through the regulatory impacts of having to grow a business in India, but we have a sizable presence there. We're always looking for businesses that have good operating cash, and so those are all the types of things that we sort of always tick off as for a strategic buyer, and I say this as someone who's an M&A lawyer for my company, so it's self-serving, but I think our M&A strategy in the past really helped us last year in sort of diversifying our portfolio. We are predominantly in the transportation space, and last year, all passenger transportation essentially ceased. On the transit side, our main customers are New York City Transit, the London Underground, and the Paris Metro, and people stopped commuting to work. And you saw people stop traveling, and so you had a significant amount of industries who were only in that space who saw depressed revenues or who needed the discussions of the large bailouts. But for us, we sort of always wanted to diversify in the space of both freight and goods movement as well as people movement. And historically, the people movement aspect of our business has always been, I would say, the steady revenue. People before COVID always went to work every day. You always had the same amount of ridership every day. And that market was completely impeded last year. And, so our freight market really took off because when people weren't going to work, they were buying a lot more things. And so the amount of goods we were shipping worldwide, dramatically increased. And so for us, sort of having that, flexible M&A strategy and always thinking, not just in, one side of the rail sector, but playing in sort of all factors of, rail adjacencies, transportation. We now have a, bus business, and sort of always thinking about what's on the next cusp within transportation, I think has really helped us weather through the hard year of COVID, and has really poised us for, a great 2021.
Yeah, really interesting comments from Christine. And I'm obviously not a strategic buyer, but we work with strategic buyers all the time. And I will say, kind of in the period leading up to the pandemic, there was definitely fairly frequent and consistent surprise at strategic buyers in our industry, which again is building products and building services, and generally, historically has had a little bit less of private equity activity, though that is rapidly changing. But especially in the years kind of 2015, 16, 17, 18, in our processes where we had a client that was kind of a perfect fit for a certain group of strategic buyers, we were consistently disappointed in some of their, valuations and how they thought about M&A. And I think that is kind of steadily changed over time, but the pandemic has also been a trigger where, they kind of have gone back and looked internally at their own M&A strategy and realized, A, we need to be more focused, and B, we need to be more competitive with private equity that is now finding its way into our industry. And valuations have come up. Valuations have changed from the historical 4 or 5 times that we used to pay for every add-on we would make. And if we want to make transformational, acquisitions, that we need to be willing to pay for it, but we need to be sure about, the strategic value of that asset. And that's certainly something we try to position and hopefully do position in our marketing materials. And when we're, bringing a client to market, especially one that is a good fit for strategic buyers, an example of that is, certain markets in the United States are just by far and away, particularly in, say multifamily sectors relative to single family, there's certain markets that are really attractive throughout the United States, and strategic buyers are searching to tap those markets and buy established competitors within them to get that immediate foothold, as opposed to coming in and trying to break through from the outside in with a greenfield operation. So a little bit more of a focused M&A model from strategics, and a little bit, or maybe a lot of it, more competitive valuations from strategic buyers.
Yeah, I'll answer a question slightly different. I know we talked a lot already about for the front end of an M&A process and how it's been impacted. Taking the other end of that on the exit side of M&A for us, you mentioned this earlier, but last year really pushed out timelines of our exits. Again, strategic initiatives, the progress we've made with our existing companies really was sidelined. We had to, in many cases, change business models, pivot in meaningful ways that I think we lost a lot of time. And I think we're still sort of, for some businesses that are still impacted, we're still figuring out what the next 6, 12, 24 months looks like, because it's certainly a lot different than it was, 18 months ago. So a lot of those timelines have been stretched. I'd say others, albeit fewer, have accelerated some exits, and those are for, again, getting back to the comments around the frothiness for the best assets. When we look at our portfolio, some of our best assets, or the ones that we know are going to fetch the biggest valuations, we've considered bringing them to market sooner, given that there is the frothiness at the top end. This is a good time to bring to market something that would fetch 1 or 2 times turns higher than it normally would, even in 6, 12 months from now, when there's just more activity. So that's changed a little bit on the exit side. I'd say with respect to M&A in our portfolio, we did a lot of acquisitions last year. So of our 30 companies, we did 15 acquisitions. So a lot of those were distressed deals. Again, getting back to my comments around the smaller companies, a lot of the smaller businesses weren't able to weather the storm. They may be fundamentally well positioned, but maybe they didn't have good relationship with their banks. So the banks were taken the keys, or, they didn't know how to pivot their business model or rationalize costs in a timely enough manner. So we were definitely opportunistic buyers, and still see some businesses that haven't figured it out, for lack of a better term, for bolt-on activity. So very, very robust activity on that side. And then kind of broadly speaking, definitely our portfolio diversification, when we think of our M&A strategies, really played out. We have a lot of retail businesses, whether it's healthcare or restaurants or physical therapy. Those have been, obviously, some of them shut down for months. We also have businesses on the other end that have benefited. We have a puzzle manufacturing business that record year last year. We have a dimensional stone manufacturer. So think granite or limestone, or, you upgrade your kitchen, or modeling is at an all-time high. Again, these businesses are booming. So definitely diversification of our portfolio has helped weather the storm. And then my last comment is just organic growth has been really hard. It's been a really hard time to have a business that's squarely in an industry or an end market, and expand end markets, or expand customer base, or add a product line. It hasn't been a time that customers or supply chains were particularly accommodating for business expansion and organic growth in the normal sense of the term. So the acquisition strategy, again, my comments around acquisitions and bolt-ons have been extremely focused of ours.
Great points throughout. I think the flexibility, Christine, that you highlighted was great. And certainly, Mike, that's such an interesting dynamic of the bifurcation of, hotter assets being accelerated and going to market first. And, a lot of your traditional exits that might have happened are getting delayed now. So there's certainly seems to be this bifurcation of, depending on, where the demand is for that asset, how you're shifting around your portfolio. For our next question, what risk mitigation efforts have your companies and clients taken during the pandemic? And Mike, could you please start with the efforts taken by your portfolio companies?
Yeah, definitely early on, I'd say cash management was first and foremost the focus of the businesses. Making sure we had the liquidity to operate, liquidity for payroll, all of such. And that started with having really good relationships with our senior lenders. We saw a lot of flexibility on the debt side, lenders pausing P&I payments, making the right covenant modifications. We're still working through a lot of that, especially around covenants. But I would say there was an extremely accommodating senior lender base. And that helped a lot sort of with the early innings of cash management. And again, some of the other big areas, big levers that we pulled were landlords, deferrals, abatements, things like that. Again, a lot of accommodation throughout last year and continuing into this year. So that was really the first round of sort of risk mitigating steps we took in the portfolio. I'd say towards the end of the year, as we got a little more comfortable with what the environment looked like, the operating environment, we moved attention to cost cutting, frankly. Where we knew we weren't able to continue to grow revenues. Again, organic growth was really hard. Our management teams took in some cases, drastic actions. Many of them cut their own comp first, which is always the right thing to do. And really sends a good signal for some businesses that were really drastically impacted. We had a health club business that had to fire and then rehire 1,500 employees. So a lot of HR moving pieces around that, a lot of cost cutting, and the whole time the CEO paused his whole leadership team actually paused their comp. So we saw a lot of good things around that. Government assistance was largely unavailable to us. So when you think of the cash management or the benefit that many companies had from PPP, given affiliation roles and our relationship with the bank, that wasn't an avenue we were able to pursue. We continue to look at it, but it's very conducive to the size of our portfolio and the size of some of our companies. And I'd say where we are now in terms of, I think we've gotten through a lot of the revenue and cost changes in the business. and where we are now is looking at capital structures, equity programs for management. Retaining and incentivizing the good teams is critical. We had a CEO for one of our businesses write a personal check into the business because he knew what it meant to the employees for him to be able to say that. So we allowed him to do that. But now we're right sizing the structure, we're right sizing option programs. Last year's bonuses, were frankly all discretionary. Not many companies hit their bonus programs that we set out early in 2020. And going forward, I think a lot of the initiatives, a lot of what the businesses are doing are less metric driven in terms of the performance and the goals that we're setting out. But ultimately, what we're trying to do is align the teams, keep them motivated, keep them incentivized. I think we've got a good group of senior leaders that aren't motivated by the short-term impacts or scared off. I think they're still, they know they're in a private equity business that, the reward or what they're working for is the exit and the liquidity event. So there has been a lot of sort of managing of those expectations, recutting the deals, changing cap structures, again, to keep them focused on the upside, keep them incentivized, and keep our best teams around, because ultimately we're not business management, we're not operating these companies, we're relying on the teams to do so, and we got to keep the right people in the right seats.
Yeah, and it was actually a pretty interesting time in our world as the pandemic unfolded last year, about a year ago, and it was very interesting in part because of a lot of our clients and potential clients, folks in the industry that we knew, were actually having a great time. The roads were empty. There was no traffic on the streets. Fuel costs had bottomed out. Largely had received the essential services designation in the building market, and they had PP&E. A lot of our clients, tend to work outside on maintaining the exteriors of buildings or, building those buildings, and they had the PPE already in-house. So it was they were optimally positioned. We even had some clients where their TTM EBITDA went through the roof because they were so much more efficient and some costs had come down. Now that didn't necessarily last. And what we're seeing today, in particular in the building products world, is material spikes, cost spikes. And I think the lumber market, everyone, has probably heard something about that. The lumber market is an example of these extreme spikes that have been caused by supply chain disruption. And on the other end, an explosion in demand, in this case for residential homes and residential building, as people flock away from cities and come to places like Denver or, smaller towns that have a, better quality of life, but still a great economy. And so, how are clients kind of facing that down? They're getting better control of their supply chains to the extent that they can. And that has been a focus for all of our clients, potential clients, really pulling on those existing relationships and making sure they're getting the most favorable pricing possible, and then considering bringing some supply chain, initiatives and functions more in-house to bring those costs down. Because with that kind of volatility, it's hard to do business, and that's going to be a potential governor to the building industry in the coming years. For the past 10 years, it's been labor shortages and lack of available labor to kind of fulfill that demand in the construction market. And that is persisting still, despite the unemployment in the country. We still have a labor shortage in the construction industry. But moving forward, there's this additional variable of materials pricing. And companies are vertically integrating, moving upstream, trying to get better control of their supply chains to make sure that they can keep those costs down. As far as government assistance, a lot of our clients, potential clients, took that government assistance. It was readily available. I don't think they'll be penalized in the future for that, just again, because the pandemic, was so widespread. And then last but not least, I think, all of our clients potentially, or especially in the manufacturing space and the distribution space, they're doing more with less. And that's included some headcount reductions. And that kind of is culturally okay in these companies, because everyone understands there's a pandemic going on and there's kind of things happening that force these types of moves. But I think having been in an expansion again for 8 to 10 years, A lot of these companies hadn't really, they've just thought about growth, fulfilling demand, and now they're looking more inward to say, we could get more efficient here. We can install this machine and that will reduce headcount by X%, those types of things. Some of those larger investments in equipment have, been deferred for obvious reasons, though some companies have gone ahead, and that's been a little bit of a shaky ground. One client in particular, ordered a very expensive piece of equipment from overseas, and the equipment showed up, but the professional techs that needed to install that equipment were unable to make it in the country. So they've had this really nice piece of equipment sitting on their manufacturing floor for a couple of months, and they're just kind of waiting to get it installed and get it up and running. So doing more with less, I think, will continue post-pandemic. And I think, companies moving upstream to get greater control of their supply chains will as well.
No, and I think to sort of echo with Mike and Curry, I mean, our main struggles last year when the pandemic hit was, we're in over 50 countries, and each country had their own quarantine and lockdown rules and operations. And so we had to, negotiate in each location where our plants could be open, because a significant portion of our workforce is fundamentally can't work from home. And so there was just a lot of discussion at, sort of the government level of saying, do we classify as essential manufacturing? Are we considered rolling stock? And then, sort of once you get over that regulatory hurdle of being allowed to open, it's, the employees needed to feel comfortable that they were going to be in a space that was safe and healthy. And so we did a lot of, I would say, capital improvements to ensure that the workplaces could be, socially distanced, and that, there were cleaning facilities and additional uniforms. And we were very thoughtful about, how are we going to do this so that we can keep operating, along with sort of the, in early March of last year, the rules of what we were supposed to be doing changed every day. And, in a significant portion of our plants, we also started just manufacturing PPE because we couldn't get them from our external suppliers. So we were sort of outfitting our own people, and that was the manufacturing challenges. And then, we also had the challenges of how are we still going to meet as a public company, our guidance, what are the commitments we made to our shareholders, this year. We had, prior to, COVID last year in 2019, we did a huge transformational acquisition merging with GE Transportation. And we made a lot of commitments in terms of our, to our lenders and, to our investment community as to all of the things that we were going to deliver. And, so there were a lot of challenges to that. And, to echo Mike's earlier point, it was all cash, operating liquidity, meeting earnings and guidance. And, and then finally, I think at the end of the year, everyone realized that it was, everyone had COVID fatigue, and so I think we realized that our essentially management buyouts and management compensation wasn't going to pay out in 2020, similar to every other company, but we honored the commitments that we made as if we had met the bonus requirements in 2020, just to incentivize people that they were essentially working their regular jobs and sort of their COVID jobs. Everyone, every plant manager had to become a COVID expert overnight because they were all sort of reporting up to the chain. And so we were sort of working, these expanded hours just to keep the lights on. And, so I think for us, it was really, what are the things we can do in, the short, mid, and long term. And, a lot of the things we did was, we changed our operational efficiencies. Could we do the same amount of production with less shifts in the day because, the middle shift ended up being, a deep cleaning shift. And then when you're realizing you can sort of have those operational efficiencies, do they stay on post-COVID? So those are, topics of conversation that we're always, currently having, and then the mid and the long term, we sort of wanted to ensure that everyone who stayed with us during, what we consider our toughest year that we've had in a long time, to stick around. And so we have, long-term incentive plans, we have stock bonus plans, and we're sort of saying to our people, you stuck through us through 2020, and we're going to, compensate you fairly for that.
Yeah, a lot of diverse and interesting comments made there. To tie in some of the themes, Curry, your point about there were COVID winners and losers and certain businesses that did better than others. And, this sort of phenomenon around materials spiking, it sort of plays into this whole COVID add back and COVID adjustment that I've been working with companies to quantify and estimate the past 12 months. And it really ties in well with Christine, your comment about the complexities and challenges of being a global company. I'm working right now with about an 80 million EBITDA global company that has had COVID impacts in 4 different continents, and understanding the different governmental policies. And I'll give an example of in Poland, the way that the subsidies and assistance worked, the company was almost incentivized to reduce their production levels to a maximum volume in order to qualify for it. So it's something from a COVID perspective, we've been working really hard, and it's been a challenge to really understand what is that global and entire impact. And it's looking at historical as well as future forecasts, and we're spending a lot more time on order intake and backlog, and also understanding these periods of assistance and, Curry, to your points around headcount reductions and normalizations and right sizing the business. And Christine, you mentioned about looking at whether it's 2 shifts or at a lower amount, or how do you socially distance manufacturing personnel. It's all these factors that impact productivity and the bottom line as well. And Mike, and I think Christine, you mentioned this as well, rethinking management compensation plans. And it's not just being a metric driven, I think is a great point. All being in it together and looking at both the qualitative and long-term aspects. You don't want to have anyone be disillusioned and not feel like their efforts are going to be rewarded. And maybe it's not something that can be rewarded in the current year because of cash flow concerns, but making sure that the management team, as well as any financial sponsors or global corporate teams, their interests are aligned to the rank and file workers, I think is a really important trend. For our next question, what are some of the major themes and trends you're seeing around, from an industry perspective, consumer and market behavior perspective? And Christine, if you can maybe lead in some of your commentary specifically about some of the end markets for Wabtec.
Sure. I think for us, it's really exciting what's currently happening with the large scale discussions on the infrastructure bill. There's currently a proposal for $3 trillion in infrastructure, and we are lobbying for a significant portion of that. We recently just opened a rail freight institute with Carnegie Mellon University and one of our customers, with the hope of developing zero emission locomotives. We're prototyping, battery powered engines, hydrogen powered cells, because I think that the concepts of sustainability and green technologies is where we really want to invest. And, that's certainly something that we're doing in our own backyard in Pittsburgh, with the hope that, those themes are going to grow, nationwide with the infrastructure bill, but also globally. I think everyone is looking to reduce emissions, with the understanding that, for us, we feel that rail is the most sustainable way to move goods and people. We want to reduce emissions by 30%, and we're able to do that with some of these, new technologies that we're investing in. And I think for us, it's really just keeping our ears to the ground as to, what's happening with the new administration, but also, pushing our own initiatives in that space.
Yeah, and I'll kind of phrase it in 3 different ways that previous trends were accelerated in a major way, and one of those, which isn't necessarily consumer behavior, but one of those is kind of the use of remote tools, remote work, telework, telecommunication. That's been enhanced. There's no doubt. What we're doing right now is an example of that, and the pandemic was a trigger for that. One that applies more to my industry that everyone knows about is, commercial real estate and the commercial services industry. The retail industry has not been helped by by what's happening. Now, I think there's silver linings, and I think, you know, we're kind of transitioning from big retail to more of these small local retailers that have a higher customer touch. And in the end, that could be a good thing for, you know, the consumer and for everyone. So it's kind of an interesting dynamic, kind of interesting, meaningful silver lining that can be found in this pandemic. But certainly the bigger retailers that were already headed south, you know, the pandemic was a trigger to take them further. JCPenney and others were prime examples of that. And then the residential market would be the third one I would identify. And in a typical recession, what we would expect in our industry is a decline in residential because consumer spending tightens and, you know, people don't make large investment decisions in times of economic contraction. And then, you know, 12 to 24 months thereafter, we would see a decline in the commercial real estate market, you know, as consumer spending slowed down and businesses made decisions on leases and things like that. And what we saw in the pandemic was the complete opposite, which was just fascinating to watch. You know, the commercial market was hit the hardest and the first and immediately. And, you know, the transition to e-commerce, you know, took hold faster than it was previously. And the residential market exploded. And again, that was as folks were moving out of, you know, urban areas and moving to cities. And that was a trend that was already occurring somewhat. There's certainly urbanization and people love living, you know, close to downtown and things like that. So that was a trend kind of headed in the other way. But one trend in the residential market that was already happening and was about to hit as a tidal wave anyway was the millennial generation, which the millennial generation is, you know, the most powerful economic generation ever, and more powerful than the baby boomers. And the pandemic, you know, was a trigger, and we're, you know, the millennial generation is that kind of prime home buying age. And as a result of the pandemic, folks said, okay, you know, time to move away from Chicago, away from New York, what have you, and let's go start a family, you know, that kind of a thing. And so what we see is this explosion in the residential market. And I think what's going to be absolutely fascinating to watch is how much of it kind of sticks. You know, is there this permanent shift from commercial demand to residential? Are folks going to want larger houses to accommodate, you know, home offices and things like that? And that ties into remote work. We'll see. I think likely. I think there is going to be a shift back, you know, to somewhat normal, but there's also going to be this permanent shift that continues on that may result in, you know, kind of traditional paradigms being upended.
I'll answer the question kind of turning back to, you know, the original comments around consumer behavior specifically. I'd say a lot of the consumer behavior changes that we've seen in our portfolio companies and their customers, some more because of regulations. So, you know, capacity constraints, in-person issues around delivery of healthcare services at a physical therapy location, for example. And I'd say others were more changing behavior. So Curry mentioned remote working, but generally driving less. You know, that's impacted our aftermarket auto businesses that manufacture and distribute, you know, kind of essential car parts for cars that are, you know, 7 to 10 years old, and people weren't getting in their cars last year and continue to drive less. So, you know, we track miles driven. So again, it was kind of two catalysts for the change. Again, one regulatory driven, which we're hoping comes back, and then two, just change in behavior, which again, hopefully comes back, but I think will stick a bit, again, to Curry's comments. You know, around how we navigate those, you know, we had to find different ways to deliver products and services. The profit and cost model changed a lot for restaurants, for example, that weren't allowed to open their doors and had to do all online ordering and delivery. There's a lot more expense and cost with that. You know, there's a labor benefit, but, you know, there's a lot of consumer behavior has really changed our business. Some for the better. I think, again, getting back to Curry's point, I think it accelerated the change that was happening. So I think our businesses that were the most nimble, had the best teams, were able to make those changes quickly, efficiently. And I think a lot of them are here to stay. I'd say that one of the other things we've noticed is around the stimulus checks that got mailed out last year at different points in time. For the businesses that were more non-discretionary in nature, non-discretionary purchases, that is, we saw an unbelievable amount of order activity right after those checks were mailed out. So again, the businesses that are selling products in the 1,000 to 2,000 range, people were getting the checks in the mail and turning around and spending those dollars. So it'll be interesting to see sort of how buyers look at that period of time from now and kind of the next 12 months, as those months are still in profit. What are those going to be negatively reversed out of earnings because it was a temporary lift to profit? Again, hopefully some of these changes stick, but there's certainly some one-time in nature, uplift that businesses had. We had one business in particular, they do manufacture and distribute lotions and oils, kind of non-discretionary healthcare beauty product. They were hit on both ends of their value chain, both on the customer side. Customers were just buying less because they were in store less. We sell through Walmart, Target. They weren't walking the aisles and they weren't picking up our products. One, two, Walmart, Target, all these big retailers were allocating freight, we're allocating logistics, we're allocating shelf space to essential products, hand sanitizers, cleaning products, toilet paper for a period of time there. So shelf space actually shrank temporarily at some of the retailers, the smaller ones in particular, but so that was hurtful. And then on the other side of their business and the supply chain, a lot of the co-mans that they were using, whether they were buying the bottles, they have some fillers, some raw material processors, they moved their capacity to, I'm sure everyone has heard stories about this, they moved capacity to producing essential items, sanitizers, wipes, everything that was flying off the shelf. So again, I think that has normalized a bit. I'd say freight is still an issue for many companies, especially international freight. I think we talked about that a bit earlier, but I think there's going to be some lingering impacts going forward, whether it's consumer behavior changing or accelerating, or supply chain changes that may stay. On the international sourcing side, we had to get really creative with sourcing from countries that were more accessible to doing business with the U.S. We're not going to go back, I don't think, given I think the businesses and the supply chains are more diverse now. So again, some of these changes were good and accelerated.
Yeah, too many great points to try to tie them all in together. But Mike, I especially like your comment about non-discretionary spending. We worked with a slot manufacturer and operator that their business is very tied to tax season, and when a lot of individuals get refunds and spend those non-discretionary amounts on slot machines. And when you think about the combination of tax refunds as well as stimulus checks, they had some of their best months that they ever had. But at the same time, they had months where bars and casinos were shut down and they couldn't earn a single dollar. And then just to add on a little bit differently from a theme and trend perspective, we saw a lot of companies really spend time on product differentiation. And I'll comment on two. One, manufacturer, automotive aftermarket, that started producing hand sanitizer in the middle of 2020, and they had their highest revenue month in their history. And certainly, from a normalization standpoint, they're not going to be able to attain the same volumes going forward. But I think, when you look at something like hand sanitizer, yes, we're not going to have the same hand sanitizer sales in 2022 as we saw in 21 or 20, but it's not going to revert back to 2018, 2017 levels or 2019 levels for a good number of years. And I think this also proved to this company that they can disassemble and reconfigure their manufacturing production lines to potentially accommodate auxiliary products, as they get different demand from their customers. So I think it's given them confidence to expand their product differentiation potentially. And that also goes well with another manufacturing company we're working with that traditionally produced test strips for pregnancy and glucose testing. And now they're producing machines for COVID-19 rapid testing. And again, you're not going to have the same volumes that they've had this year and in subsequent years potentially, but we're not going back to where the world was 3 years ago. There's still going to be a large demand, and to quote the president of the business unit, we somewhat got caught with our pants down, and it's certainly something that is not going to go away. And this is a new product line that there is going to be very high recurring levels of demand going forward. For our last question, I'd like to hear about your thoughts on where things are headed. What trends are here to stay, and what major predictions do you have for the remainder of 2021? And Mike, why don't you lead off with your insights?
Yeah, thank you. I think some of the diligence efficiencies that we've talked about, whether it's traveling later in a process, using creative techniques to otherwise get to the answers that we were getting at years ago with more in-person techniques. I think those are here to stay. I think private equity investors, advisors, sellers, I think they've realized that they can do business more efficiently on the diligence side. I think we'll probably revert back to some more in-person relationship building, especially as I think about like our proprietary business where we're trying to meet entrepreneurs that haven't decided to sell their business yet. I think we'd like to get back, and I think that will return. I'm not sure that, some of the non-discretionary, what we call business development travel, I think that'll be pared down. So that's on the business side. I think just globally and thinking about the macro trends, I think private equity demand is going to be there. Strategics are still interested in putting capital to work. Private equity wants to compete with them. So there is going to be a continued frothy market, especially in the near term with, again, the best assets. I'm hopeful, and I would expect that later this year, maybe, Q4 going into early next year, some of those more B+ assets come to the market as COVID's well in the rearview mirror. There's more certainty around an exit around a B asset from a selling perspective. So that's where we play. Those are the businesses that we have theses around and we like to get involved with, businesses that we can improve. So I'm hopeful that kind of market will come back in the next kind of 6 to 12 months.
And yeah, I echo what Mike said, and I'll talk about Mike's industry for a little bit because I think it's fascinating. Having been in M&A for the past 10 years, the private equity industry has evolved in a major way, and we're seeing that, maybe accelerated a bit, but it's a hyper competitive market right now on the buy side, and that's driven in part by the amount of equity capital out there. That's also driven in part by just the fact that the industry has now been around for a much longer time, and private equity is not kind of the boogeyman that it once was. And that competition is, driving a number of changes. I think processes have to become more dynamic. A lot of processes for quality assets have been preempted by certain buyers at beginning stages, and that creates complications as an advisor because you kind of want to see what the other buyers were going to offer. You also need to keep this buyer, honest in your process and make sure they can close after going under letter, which, can always be a scary thing. So you kind of have to come up with creative ways to keep the heat on them, such as milestones through a diligence process and more closely watching them through that diligence process, making them accelerate that diligence process. But the overall evolution of private equity and the competition is leading to higher valuations, and private equity finding its way into new industries, new sectors that formerly, it didn't necessarily touch. And I think as a building products and building services, focused bank, we're seeing that in a major way. And we're seeing specialty private equity firms, holding companies come into our industry and drive up valuations across the board. And it's a bit of a, kind of a market rotation that you would see in the public markets. As valuations go to the moon for quality assets, then buyers who have a lot of cash start to look for lower quality assets. And, it's not to say that they don't make great returns. It's just that you have to structure the deals properly to account for cyclicality in some businesses or higher CapEx in some businesses. It just kind of depends, but we are absolutely seeing that rotation. And an example of that is HVAC services. The HVAC services market has exploded, and the valuations for the companies that you and I call to fix our air conditioner or our heater have gone to the absolute moon. And formerly they weren't very interesting to private equity because there's really not much in the way of barriers to entry for those companies. But the valuations over just the past 3 years have gone, to the upper teens as far as EBITDA multiples for the leading platforms in the industry that are, still sub 20 of EBITDA. And that's leading to interest in the installation companies, the non-maintenance based companies, because buyers want to get into that industry so badly. They'll look for other avenues to access that where they don't have to pay an upper teens EBITDA multiple to get into the industry. So that's an example of a rotation that we're seeing, and our industry is frankly benefiting from. As far as other trends that I'm seeing from an investor perspective, looking kind of upstream when we take our clients to market, thesis-based investing and consolidations are two themes that we're seeing repeatedly. And, that I think it ties into an overall kind of specialization across the M&A world. You need to know a lot about an industry. I think the days of the generalist, are not over by any means. And there's a bunch of great generalists out there and they do a fantastic job. But the folks that have, sector expertise or partnered with an executive that has great expertise in an industry, and then they pursue, say a consolidation play, we're seeing more and more of that. It's that specialization that gives you an advantage in the process, lets you pay the right value, and also lets you relate, to that company and its executives and help them understand how much value you're going to add, on a go-forward basis, which of course helps them in their potential rollover equity. So I do think specialization and industry experts will win the day going forward. And I expect the markets overall, kind of stepping back and thinking about 2021, I think the frothiness is here to stay. There's simply too much liquidity on the sidelines and a lot of deferred, big investment decisions coming out of the pandemic that just need to be made.
Just sort of to wrap up, I think Curry and Mike, have stated a lot of things that we're certainly seeing as a strategic buyer. For us, it's been, I think 2021 started and we're off to the races, and it doesn't look like there's anything slowing down. To echo Mike's point, I think there were just a lot of sellers last year who want a clean exit. And, coming to a large company like ours where they no longer have to sort of deal with, the day-to-day regulatory hurdles. They can come into work every day, run their plants, but they have a corporate overhead that does benefits, payroll, legal, all of those things, that makes us really attractive. And, from our end, it's we can't get deals done, fast enough, but what we're hoping to see is that, there are a lot of technological efficiencies in terms of doing everything over Zoom and Zoom meetings. But, particularly in M&A and within the rail industry, it's all a relationship-based business. For us, it's really important that we get to know these people when we put them into our portfolio. We really, we're not necessarily in the business of divesting. And so these are long-term players for us. And so I think that while there are a lot of efficiencies you can get from, Zoom meetings, it really can't replace the sort of people-to-people aspect of M&A and, having them come join you as employees. And, we're making an investment in their business, but we're also making an investment in these people to grow a product line, to grow in a new market, so for us, hopefully, the back half of 2021 will sort of go back to, pre-COVID world in terms of actual diligence or having some of the, what our executive management team considers the fun stuff of M&A, the meetings, the events, because otherwise, to Curry's earlier point, diligence is just a grind and it's on top of your other day-to-day job. So I think that some of those positive relationship incentives, for us are really important, and we'd like to see them come back.
Yeah, I think that's a lot of great points, Christine, and everyone else about specifically utilizing technology. And certainly we'd all like to go back into in person, and that's what we're envisioning in the long term. But there are going to be certain dynamics that are going to stay remote, and it's something that we are certainly anticipating. And it's not going to be a one-size-fit-all approach for us for diligence. It's not just going to be we travel for the larger deals and we're back in our houses and in our offices for the smaller deals. It's going to be a very measured approach based off of sophistication of the accounting team, the deal timeline, and the fee sensitivity of our client. And then, Curry and Mike, I think great points around valuations being here to stay. Certainly we've seen a shift in our clientele where it's been 50-50 over the last 2 years, we're probably 75% sell side and only 25% buy side these days, as everyone's trying to go to market and take advantage of, I'm going to use it again, the frothiness of where M&A valuations and multiples stand today. So I see we're at 1 o'clock now. I don't see any questions in the Q&A window. So certainly if you have questions for any of the panelists, please contact Micah or the rest of the ACG staff, and I'm sure they'll be able to help with your questions. Just some last concluding notes I've been asked to say. I'd like to thank our esteemed panel for their time and commentary today. A survey link will be sent to all attendees following this program. It really helps us plan future programming and whenever you complete those surveys. And the next ACG chapter virtual program is on April 6th from 1:45 to 3 p.m. It'll be a fireside chat with Michael McGarry and Ann Fowlks of PPG Industries. We hope to see you there and have a great rest of your day.